Davies. Appeal in the matter of Scott and HMRC.
My lords, my lady, I appear on behalf of the appellant taxpayer, Mr. Scott, with my learned friend Mr. Firth, and my learned friend Mr. Pritchard appears for the respondent commissioners. As the court will, I have seen, the facts in this matter are all agreed, and happily for the most part it's been possible not merely to argue this case on agreed facts, but on highly simplified assumed facts, simply in order to make the arithmetic rather easy to follow. The essential issue is that over 2 years of assessment, 06-07 and 07-08, Mr. Scott became entitled to an amount of what is known in the tax code as corresponding deficiency relief, which resulted from losses arising on the disposal of life policies.
Yes, we're rather fascinated to know how one makes these huge gains out of dealings in life insurance policies, because that's not dealt with in the agreed fact. It would have been quite nice to have known how exactly they're made. Or is that not something it's not relevant to the disposal of the action of the issue, but it would just, I mean, normally in a normal case you would have the background facts as to how one made, in this particular case, the gains, and how the losses arise, and so on and so forth. I mean, that's sort of cut short. Are we allowed to know that? Or not?
In principle, it stems from the way that I don't personally, my lord, know the precise factual background here, but in principle, it stems from the way that life policies are taxed, which is under a rather primitive system, under which you make a gain at the end of the period of time in which you have held the policy, but the amount of gain that you make is computed by reference to what is in many ways a rather arbitrary formula, which often doesn't result in any gain which is which would economically be recognised as a gain.
It's not. I mean, everybody's familiar with the idea that there's a market for the person to say the life insurance policies, but this isn't anything to do with that.
Yeah. Sorry, I have a note here which I can't read. I will. If I may, I can come back with a bit more detail on that.
Yes, I mean, it's not an arched question. It's a genuine interest, because it doesn't sound as though it's making money in a market which we're all aware of, which is buying and selling other people's insurance policies, life insurance. It's not to do with that.
It's not. The gains are not computed in the way that chargeable gains are computed. So it's not the case that you simply take your purchase price and deduct it from what you sell. It's
anyway, what I gather from what you said is that these gains are made in some way or other as a result of various tax events.
Yes.
That's what it's to do with. Are these policies a policy on the taxable person's own life, or are they other people's lives?
I think probably these ones were on another person's life, but they're investment policies.
The life insured was probably somebody else, but all of these policies are investment policies. So they're simply means of investing money, which has a life policy element within it, which qualifies it for tax treatment as a life policy. So it's not simply term insurance insuring £50,000 on the death of X. It's a rather more sophisticated product than that. But the point, perhaps, my lord, the point to note is that just as the amount of the gain which you can make on these policies can be very substantial, so can the amount of the loss that you can make on disposing of them as well. So the same rules apply for computing gains and losses, or at least they did at the time of these transactions. So it was possible by buying and disposing of these policies, both to make substantial gains and to make substantial losses. Essentially what has happened here...
I'm so sorry, so buying and selling the policies, I thought you said that buying and selling the policies doesn't give rise to the economic loss here. That I thought you were saying that it's by virtue of various taxable events that the losses arise, not through buying. It's not like an economic gain or loss.
It isn't. It's on the disposal of the policy. You may make a gain or you may make a loss, but the size of the gain or the size of the loss is computed on a statutory formula, which is capable, depending on the circumstances in which you've acquired the policy, in generating a large gain or a large loss.
Mr. Furnace, it's well known there were a lot of tax avoidance schemes which took advantage of the insurance policy regime, of which probably the Ships 2 scheme, which came before the Court of Appeal in the Mays case, which of course you well know, was probably the most notorious. I mean, I'd rather assume that, not that it is relevant, I'd rather assume the background to this case was something of that nature.
Something similar, my lord, yes.
Given the amounts involved and the rather puzzling looking outcome where the taxpayer gets a gigantic amount of CDR without having actually had to pay any tax on the earlier chargeable events, which took place when the relevant policies were held offshore. Something like that.
Well, my lord, it is something like that. I am genuinely, I'm sorry, I must apologise to the court. I'm genuinely not privy with the structures which preceded the issues which are before the court today. But I can find out and.
Don't worry about that. As my lord has said, it doesn't help us to resolve the issue of interpretation. But I think we were all just rather curious because we hadn't really come across this before about how one makes these massive gains and losses. Well, I think we understand how the loss is computed, but they're massive gains certainly. But anyways, I wouldn't take up your time more on that point. Can I just say also, by way of introduction, in case it helps you, we've obviously read the decisions below and the skeleton arguments and the agreed statements and so on. For our part, we don't think we need to see and study the legislation other than the ones we're actually concerned with. So earlier legislation, we understand what's said about it.
Yes. We
see how it's dealt with below. I'm not sure that we're going to gain much from looking at the earlier legislation. We prefer, if you're content with this, that we study the legislation that actually applies in this case. That's the first point. It might shorten things a little bit. But I don't want to circumscribe you if you feel you really must, in the interest of your client, refer to the earlier legislation. And the second thing is, we understand it's now agreed that although the legislation relating to the second year of assessment, the subsequent year of assessment, is worded differently, that the outcome is going to be the same in terms of the issues that we're concerned with. And so again, we wouldn't have thought that you would need to spend time on that because we've seen what it says and so on. So for our part, we think it would be most helpful to us to go straight to the legislation that applies to the first year of assessment.
Well, I'm very happy to do that. I mean, to cut short what I was going to say, the court is clearly apprised of the basic issue, which is the question whether or not the amount of corresponding deficiency relief, which is available to Mr. Scott in these 2 years, which exceeds the amount of his income, as that income is computed for the purpose of the capital gains tax legislation, is available to him, even though it produces, as it were, a negative figure in the course of the computation for the amount of the unused basic rate band.
But that is the issue.
That's the issue, yes. So what we say in general about the legislation, and perhaps the only point that I would refer the court to, and let's get this out of the way, to the original legislation, is to the chapter heading, which this appears behind tab 1 of the authorities bundle. one sees under Chapter 4, Capital Gains, the heading Unification of Rates of Tax on Income and Capital Gains. Now, that we say, now of course, one always has to bear in mind with chapter headings in Acts that they are a very broad summary of the content of what follows. But nonetheless, they are part of the Act and they can be taken into account in its construction. And we say that that is, right at the outset of this process, a clear steer as to where Parliament was going. And we say that you can learn the same lesson, as it were, from looking at the terms of the sections as well. But the advantage, in a way, of just looking at the original legislation, and I'm not going to go through it, is that one sees that it started out all in one place. As a result of consolidations, by 2006-07, it's been scattered into different acts, but it all started as a single unified little code, which was intended, as the heading says, to unify the rates of tax on income and capital gains. So that's all I wanted to show the court on that. But to return to the general point that I was making, in my submission that it's clear, and indeed the upper tribunal found, they agreed that the general aim of the Act is to unify rates of income tax and capital gains tax. And one sees that in very simple examples, one sees how that works. It's quite easy to grasp that if you have a basic rate limit of £40,000, you have income of £20,000 and gains of 40. Your income uses up 20,000 of your basic rate band, and then you've got 20,000 of it to give you £20,000 worth of basic rate tax on your capital gains, and then the rest is taxed at the higher rate. So in those simple situations, it's very clear that it matters not whether you have income or gains. If you have no income and all gains, or no gains and all income, or a mixture of the two, the tax result is always the same in terms of the amount of tax that you end up paying. The complication arises in relation to some specific provisions within this little code, which was introduced in 1988, but the specific provisions are now in Section 6 of the Taxation of Chargeable Gains Act, or at least they were in the relevant years. The complication comes as a result of provisions within this code which allow reductions in respect of certain types of relief. Now, there's an important point I'd like to establish at the outset before we start looking at the reasoning of the upper tribunal, which is where I propose to go next, which is that there are, in principle, two kinds of relief that are being discussed in the decision and which are, in principle, available. One is a relief which reduces your income for tax purposes. Or it may, as the case may be an allowance. When you're computing the amount of income, your taxable income, there are certain types of relief, like, for example, loss relief, which allow you to make a deduction from your income. So your income gets smaller, and that's why your tax bill gets smaller. And there are other types of relief which go to the rate of tax, or the amount of tax, that you actually pay on whatever your income is. So they don't reduce the amount of your income. They simply alter the amount of tax you might otherwise pay. And the court will have seen throughout this concept of total income, which is referred to in the legislation, which is an income tax concept, which is in principle reached by adding together all of your various elements of income, so whether it's your trading income, your income from interest, dividend income, income from land, all of those various components of your income, computed in accordance with the computation rules for the particular type of income in question, are added together to get taxable, to get total income. And then your taxable income is your total income less reliefs and allowances. So allowances typically will be your personal allowance, which will shave some thousands of pounds off the level of your total income. But reliefs will be something like loss relief, whereby you can say, well, part of my income I can now ignore for tax purposes completely. But then there are other reliefs, and CDR is an example, where the relief doesn't operate to reduce your total income, it simply operates to change the rate of tax at which you would otherwise pay on your income. And the reason I stress that division is that we completely accept, and have always accepted, that reliefs which simply reduce the amount of your income are not, as a result of our construction, capable of being transferred over to capital gains tax. So that, for example, if you don't use, if you've got loss relief, which wipes out all of your income, it's no part of our construction that you can then use part of that relief to set off against your chargeable gains for the year. You may be able to carry it forward against your income in the following year. But we fully accept, and I did before the upper tribunal accept, that in general your total income for income tax purposes will not be negative, simply because the tax code can't deal with a negative total income. Total income is what you pay tax on, and obviously you can't pay tax on a negative figure. So we've always accepted that, and we've always accepted that deductions from total income, in the sense of reliefs from the amount of income on which you pay tax, are completely outside the scope of the capital gains tax legislation we're looking at now. But with corresponding deficiency relief, we are looking at a relief which alters the rate of tax. And in a code which is designed, as it says, to unify rates of tax, that is absolutely the sort of relief that one would expect you to be able to use both against your income and against your capital gains. And there is no question that as a result of the capital gains tax legislation, it is possible to use your corresponding deficiency relief to reduce the rate of tax that you pay on your capital gains. And that's because, as we'll see when we come to the legislation, but as the court is probably already aware, because there is specific provision which allows you to deduct or to reduce your income by the amount of your corresponding deficiency relief. And even HMRC accept, as of course they must, because that's what the Act says, that there are situations in which your corresponding deficiency relief will benefit you, will reduce the rate of tax that you're going to pay on your chargeable gain. So there is no dispute that corresponding deficiency relief and other reliefs identified in the legislation, but we're just concerned with that one, can be used to reduce the amount of tax on capital gains. And the dispute between us is not whether or not that can be done, but simply the scale, or the scale on which it can be done. Whether or not there is some limit implicit in the legislation on the amount of CDR which in any given year can be set off, can be used to reduce tax on chargeable gains. Now, I'm labouring this point, and I'm conscious I'm labouring it, because in my submission it's a point which the upper tribunal seemed not to have taken properly into account. As I said, we accepted in the course of the hearing that total income for income tax purposes normally would not fall below zero. But the acceptance of that for income tax purposes, total income can normally not be less than zero, has been used by the upper tribunal, when we come to look at their reasoning, to reach two complementary and, we would say, erroneous conclusions. The first is that because total income in the income tax context cannot normally be reduced below zero for income tax purposes, that fact, that conclusion, is somehow relevant to the question whether a relief against the rate of tax payable, i.e. like CDR, which is not fully used, can be used to relieve tax on chargeable gains under a special unified system of tax rates. We say it is simply a non sequitur to take, I'm not even going to call it an admission on my part before the upper tribunal, but simply an acceptance of the reality that total income normally will not, for income tax purposes, fall below zero. To take that and say, well, therefore, where we see the concept of total income being reduced in the capital gains tax context, that somehow there is some artificial limit there, below which you cannot go. And the other erroneous conclusion, which I submit the upper tribunal reached, and the first tier tribunal as well, is that it's an unacceptable consequence of our construction that income tax reliefs will become available to be set off against capital gains tax. And it said that was never the intention of the legislation. Now, we say that that's simply not a consequence of our construction. All we are saying is that some specified reliefs, and CDR in particular, can be used to reduce the rate of tax that you pay on your capital gains. We're not saying, and it doesn't follow from what we're saying on that the whole gamut of reliefs which can be used for income tax purposes to reduce the amount of your income can be used, can be transferred across into the capital gains tax context.
But even taking this one relief in isolation, which I accept for present purposes one has to, where, as in a case like this, it amounts to many millions of pounds, I mean, the effect of that is, isn't it, to give you, for capital gains tax purposes, the benefit of a relief, albeit one relating to rates,
Yeah.
which was introduced specifically in an income tax context.
Well, of course it was, but we say that's the consequence of the wording which has been used in this
It all comes
legislation.
down to the meaning of section 6, subsection
Well,
2.
it does, my lord, yes. What I'm concerned about here is the reasoning, which we'll look at in a moment in the upper tribunal, which seems to think that if they agree with us on CDR, that somehow this opens the floodgates to all sorts of other reliefs being brought in as well.
I'm not sure I read it that way. I mean, anyway, for present purposes, I'm quite content to accept we have to look at CDR by itself, and without bothering too much about any possible knock-on consequences in relation to other reliefs.
And the other main point, by way of introduction, again before we look at the reasoning of the tribunal, concerns the purpose of the legislation, and the court would have seen this is really our first ground of appeal. It is, we say, striking and right that the upper tribunal accepted, as they put it, that the general aim of the legislation was indeed to unify tax rates, but then we say essentially failed to follow through with that conclusion and use it as a guide to the correct construction of the legislation. We say that our construction effects fully and in accordance with what Parliament must have intended, a unification of the rates in the way that HMRC's construction does not. We say that the upper tribunal, essentially by saying, oh, well, we have to give priority to the specific wording of the section, failed to give enough, or indeed any weight at all, really, to their own conclusion on what was the overriding aim, or we would say the overriding purpose of the legislation. So if we now turn to, if the court's agreeable, I thought the easiest and most efficient way of dealing with this is to go through the reasoning of the upper tribunal and explain why we think they've got it wrong. Does that, and because they set out the legislation, we can go through the legislation at the same time. So if we turn up the upper tribunal decision behind tab 6 in the appeal bundle and turn to page 9, we at the bottom of page 9, paragraph 24, we see the form of section 4 of the 1992 Act as it was for 2006-7. So subject to the provisions of this section, the rate of capital gains tax in respect of gains accruing to a person in a year of assessment shall be equivalent to the lower rate of income tax for the year. That had changed from the basic rate previously, but there's no significance to that. I mean, in the following year it changes again. But the basic principle is that you pay tax at in this year the lower rate of income tax for the year. Then there's a special provision which didn't originally exist in the legislation to do with trustees of settlements, which we needn't be concerned with. And then 1AB and 1AC deal with what had by then come along as the starting rate of income tax, which was the level of income tax you paid before you got into basic rate. And again, I don't think we need detain ourselves over the detail of how that works. Essentially, the mechanism is the same as the mechanism for basic rate. So 1AC talks about the unused part of starting rate. An unused part of an individual starting rate band are the amount by which the starting rate limit. So it's the same concept, but just used in relation to a preliminary band of tax. And then 2, 3 and 4, which are essentially a transcription of the original legislation, the original section 98. If income tax is chargeable at the higher rate or the dividend upper rate in respect of any part of the income of an individual for a year of assessment, the rate of capital gains tax in respect of gains accruing to him in that year shall be equivalent to the higher rate. So if it's easy, if you're already paying higher rate tax on your income, then you pay the same on your capital gains.
Yeah. Even if it's only £1, you're paying
Even if it's only
higher
one,
rate tax on
yeah,
that,
yeah.
then means all your capital gains are going to be taxed at the higher rate too.
Yes, yeah, well, yes. And then 3, if no income tax is chargeable at the higher rate or the dividend upper rate in respect of the income of an individual for a year of assessment, but the amount on which he's chargeable to capital gains exceeds the unused part of his basic rate band, the rate of capital gains tax on the excess shall be equivalent to the higher rate of income tax for the year. So this is introducing the concept of the basic rate band, and if your gains are within it or don't exceed it, then their basic rate, and otherwise their higher rate. And then the key definition at the bottom in 4, the reference in subsection 3 above to the unused part of an individual's basic rate band is a reference to the amount by which the basic rate limit exceeds his total income as reduced by any deductions made in accordance with the Income Tax Acts. Now, those deductions made in accordance with the Income Tax Acts is we would submit, and I think it was agreed by HMRC below, are the deductions that you would make from your income in an income tax context. So things like loss relief and other reliefs that would reduce the amount of your income. So you start with total income and then you reduce it by deductions, and it would also include the personal allowances. So 4 is essentially looking at is taking total income for income tax purposes and then reducing it down in accordance with the Income Tax Acts to taxable income, and that then allows
it's net total income.
it's net total income or taxable income.
Net total.
Yeah. Am I right, before I forget, that total income, although a commonly used expression, was not actually a statutorily defined expression?
Lord, it is defined, yes.
Or had become defined by this stage?
It had been defined, sorry.
Okay.
Give me,
It's so perhaps you could just tell us all
where
where we
we-
find that.
I'll find you the definition, Lord, yes, or my learned junior will.
Thank you.
So we've got that, yes.
So that takes us to the end of section 4, and then section 6 deals with other special cases and provides that where for any year of assessment, by virtue of section 539 of ITOIA 2005, a deduction of an amount is made from a person's total income for the purposes of extra liability. And then there's another special case which doesn't concern us. Section 4.4 shall have effect as if his income for the year were reduced by that amount. So you need to find out what the amount is which is deducted under 539, and then you reduce the income under 4.4 by that amount. And as the court will be aware, the issue is whether or not by reducing income under 4.4 by that amount you can reach a negative figure against which to place the unused part of the basic rate band, or against which to compare the basic rate limit.
So basically, as my lord said right at the outset, it all turns on section 6.2.
It turns on the combination of 6.2 with 4.4. Yes. And then the tribunal set out the other key statutory provision, which is section 539, which is relief for deficiencies. And that provides a deficiency from a policy or contract arising on a chargeable event is allowable as a deduction from the individual's total income for a tax year if a gain had arisen instead on that event. So it starts off by saying it's a deduction from total income, but we'll see that it's only for a very limited purpose. And you have to fulfill conditions A or B in order to get relief. And then subsection 3 says that subsection 1 only applies for the purpose of determining the individual's extra liability, and subsection 4 says that an individual's extra liability is the amount by which the individual's liability to income tax exceeds the amount it would be on the assumptions specified in 5 and 6, and it is assumed that income tax charged tax at the higher rate is charged. Sorry, where's this from? Yeah. It's assumed that income is charged on the hypothesis that income charged is charged at the lower rate, and in any other case at the basic rate, and that income charged at the dividend upper rate is charged at the dividend ordinary rate. So the assumption essentially strips out all of the higher rate tax levels and assumes that to the extent that your income is covered by CDR, it is taxed at basic rate rather than higher rate. So purely for the computational purpose of deciding how big your tax bill is, the amount of CDR is deducted from your total income, and your total income is computed on the basis that to that extent you're paying basic rate rather than higher rate tax. It's a rather complicated formula for saying that to the extent you've got corresponding deficiency relief, you can pay basic rate rather than higher rate tax on that slice of your income.
Can we, for the purposes of simplicity and just to avoid getting into unnecessary detail, assume we live in a world where income tax is chargeable at basic rate or higher rate?
Yes, and the virtue of looking at the original legislation was that you were in that simple world.
Yes.
So it was so all of these extraneous provisions don't trouble you. But
I mean,
what
it's put in a very, it is quite confusing, isn't it, the language that's used in 539. But basically you're saying that what it comes down to is the extent, I think the way you put it was, the extent to which income is covered by CDR, it's charged at the basic rate.
Yes.
Rather than the higher rate.
Yeah.
That's how you would encapsulate what that section means.
That's the way it would normally work. Yes. So what perhaps one needs to bear in mind by way of background is that gains on life policies are only taxed effectively at the higher rate. The life company pays basic rate tax on the assets within the policy, and when you make a gain, you effectively get a credit for basic rate tax, and you only pay higher rate tax on the gain. So that's why the relief for deficiencies again is targeted only at higher rate tax, because it's just reverse. It's the opposite of the tax benefit. The tax liability you would have had if you'd made a corresponding gain. But just pausing with 539, we see that in 5391, what is allowable as a deduction from an individual's total income for a tax year is a deficiency from a policy. So what is allowable as a deduction is a deficiency.
So where are you referring to now?
This is 5391.
So 539.
Yeah.
So far as you're aware, everybody's in agreement about your shorthand description of the effect of section 539, are they? Yes.
Yes.
There's no dispute about the way you generally described its effect.
Yes, I mean it's not a substitute for when we come to seeing how it operates in conjunction with the capital gains tax legislation. It's not intended to be a substitute for actual reading of the act, but as a general summary of how it works in the usual case. That's
and that point about chargeable at the basic rate is really the effect of 5395.
yes.
Really, that's a rather curious language, but it's all about 5395 is the one that sort of says effectively what you've summarised. Yes. Right.
So as I was saying, 5391 says that a deficiency from a policy or contract arising on a chargeable event is allowable as a deduction from an individual's total income. So the amount which is allowable as a deduction is the deficiency. So if you have income of £10,000 and a deficiency of 20,000, the amount which is allowable as a deduction is £20,000. Now, in a purely income tax context, you can only use 10,000 of it, and because you can't carry it forward, the other 10,000 will be wasted. But the amount of the deduction in 539 is a deficiency arising on a chargeable event. So when section 6, subsection 2, which is just at the top of the page, says by virtue of section 539, a deduction of an amount is made from a person's total income for the purposes of extra liability. That amount is, we would say, the amount of the deficiency. So, if we could just, before I go on, refer the court to the definition of total income, which Lord Justice Henderson asked for. it set out, I knew it somewhere in the decision, it's in paragraph 12 of the decision. This is the ICTA definition, which of course was the one in force in 2006-7. It's the total income of the individual from all sources estimated in accordance with the provisions of the Income Tax Act.
Thank you.
Now, having set out the legislation, the Upper Tribunal now moves on to address the arguments. This is paragraph 27 on page 68 of the bundle. They do so by reference to these worked examples which they took from our skeleton, which assumes that you have a taxpayer who has zero income, £35,000 of CDR and chargeable gains of £100,000. And on our computation, total income for section 98(4) purposes, total income for income tax purposes is, on this hypothesis, zero. You reduce it by the amount of the CDR, which is £35,000, and you get a figure of minus £35,000. And therefore, the unused part of the basic rate band is 40,000 minus 35,000, which is 75,000. And that results in £75,000 of your gain being taxed at the basic rate, and 25,000 being charged at the higher rate. And that £70,000 corresponds to the assumed basic rate limit of £40,000 plus the 35,000 of CDR. So you're getting the benefit the full benefit of your CDR relief reflected in your capital gains tax computation. And that produces the same result. If we go a little earlier on to example 1, for example, in our no, I do feel that's not really a very appetite comparison. So that's our construction. The revenues construction is again that total income is zero, but that on the revenues construction, because you cannot deduct or reduce total income below zero, the unused part of the basic rate band is 40,000 minus zero, i.e. £40,000, and the result of that is that tax is charged at the basic rate on 40,000 and at the higher rate on 60,000, and the benefit of the corresponding deficiency relief is not available. Now, the merit, we would say, of our construction is that if you assume CDR of £35,000 and total, to use a neutral term, receipts of £100,000, that split of 75,000 at basic rate and 25 at higher rate stays the same, whatever combination you use, whether or not you assume 100% income, whether you assume 100% gains and no income, which is example 3A, or whether you split it down the middle. Let's say it's 50,000 of each. Because the rates are unified, it doesn't matter. But under the revenues approach, it does matter. So that if, for example, instead of 100,000 of gains and no income, you had 100,000 of income and no gains, you would reach the same result as in 3A. You would have 75 at basic rate and 25 at higher rate, because the CDR would be available. Obviously, revenue except CDR is available to be set against income. So, under the revenues approach, the amount of income or gains charged at basic rate and higher rate varies depending on the mix between the two. And that, we say, is the antithesis of creating a unified rate of tax for income and capital gains. Paragraph 30 records my submission, which we repeat, that essentially section 4.4 is a formula which has to be followed through and gives the results it gives. And the upper tribunal have, I think, accurately reduced my submissions to an algebraic formula, although, as they rightly say, it's not actually the way I would propose to put it myself. Now, then, in paragraph 31, the tribunal, with respect, rightly note that our argument depends on section 6.2 requiring the total amount of the deficiency to be subtracted from the taxpayer's income in order to find a figure for the purposes of section 4.4. And they say this is not what 6.2 says. They say what 6.2 says is that section 4.4 shall have effect as if his income for the year were reduced by that amount. This must be a reference back to the amount referred to in 6.2a, which applies where, by virtue of 539 of ITOIA, a deduction of an amount is made from a person's total income for the purposes of extra liability. That takes us to 539, which says a deficiency is allowable as a deduction from an individual's total income, but only for the purpose of determining an individual's extra liability. Well, we say, as I've already said, that what 539 says is the deduction is the deficiency. And although, of course, we accept for income tax purposes, if the deduction exceeds the amount of total income, it's wasted and has no part to play in the computation of tax. We say that the draftsman in the capital gains tax legislation chose his words carefully. And when we look at 2007-2008, where the legislation is rewritten, our construction of the way that 6.2 operates is made explicit, and the upper tribunal accept that this argument about the amount no longer works for the second year in quite the same way. They manage to persuade themselves to the same result, but the wording in 2007-8 is explicitly in our favour because it talks about the amount of the deficiency. But we say that the same construction is correct in 2006-7 on the earlier legislation, and the draftsman of the rewrite correctly interpreted what Parliament intended when he rewrote it in 2007. So here, and then we see it in the tribunal's reasoning at paragraph 32, the bottom of page 69, going back to my acceptance that in the ordinary case of reliefs and allowances, the amount deducted could not exceed the amount of income, would not reduce taxpayers' income to below nil or a negative figure. And they say, well, we've been unable to see any reason why it should be any different with the relief given by section 539. Effective 539 at CDR is available to the taxpayer to be used as a deduction from his income. But we do not see why in this case, any more than any other case where allowance for relief is available, that deduction can be used to reduce his income below zero. Well, the first point is that the relief given by 539, although it talks about a deduction from total income, does not actually make a reduction in total income. You still pay tax on the whole of your total income. It simply makes an adjustment in the rate of tax that you pay. But the second point we make about this is that regardless of what the position would be in the world of income tax, we are here dealing with capital gains tax and an attempt by Parliament to unify the rates of the two taxes. So just because, and I accept, just because under section 539, if your CDR is bigger than your total income, some of it will be wasted because you can't reduce your total income below zero, has no bearing on whether or not under the capital gains tax legislation, section 4 and section 6, that relief cannot effectively continue to be used to affect the rate of tax as it's applicable to the capital gains. And in a unified system, we say that is the result one would expect to see. The point, this point with respect we fundamentally disagree is expanded further by the tribunal going down paragraph 32 at the top of page 70 of the bundle. Around line 10, they say, in our judgment, if taxpayer has an income of 10,000 and CDR of 35...
Where are you reading from now?
Sorry, line
Carrying
10.
on.
Line 10,
Yes.
page 70.
Yes, thank you.
Yes. They say, in our judgment, if a taxpayer has income of 10,000 and CDR of 35,000, the effect of 5391 is to permit 10,000 of the CDR to be used as a deduction from his income, so that his income is reduced to nil for the purpose of calculating his higher rate tax liability. It is not to permit the whole of the 35,000 to be deducted from his income, so his income is reduced to minus 25,000 for the purpose of computing his liability to higher rate income tax. Well, clearly not. It would make no sense to have an income of minus 25. They say that would be inconsistent with the general principle that deductions by way of reliefs and allowances cannot ordinarily reduce the taxpayer's income below zero. Well, as I say, that acceptance was to do with reliefs which reduce total income. This relief in 539, although it's phrased in terms of reducing total income, is in fact simply a device to alter the rate. But even leaving that aside, it simply doesn't follow that because in the income tax context, it would make no sense to reduce total income to minus £25,000 for the purpose of the high rate tax computation. That does not mean, in a unified system of rates for capital gains tax and income tax, that you shouldn't be able to, as it were, take that unused part of the CDR away from your income and use it to claim basic rate tax on your gains. We there see that that reasoning in paragraph 32, which I've just addressed, seems to play a fundamental part in the reasoning of the tribunal. They say, in the light of that conclusion, it seems to us inevitably to follow from the language of 6.2 that the amount which the taxpayer's income is to be reduced for the purposes of 4.4 is similarly limited. Thus, in the example we've just given, the taxpayer with income of 10,000 CDR 35,000, the amount of the deduction is not 35 but 10, and that therefore is the amount referred to in 6.2a. And they go on to make a similar point in relation to the worked example we just looked at in paragraph 34. And then in paragraph 35,
they're concentrating to a large extent, aren't they, on the final words of 6.2, shall have effect as if his income for the year were reduced by that amount.
Yes.
So they're sort of focusing to a large extent on that. And because the income can't be reduced, they say, below zero, those last words impose a limitation. That's effectively what they seem to be saying.
Well, they seem to be saying that because total income in the income tax context cannot meaningfully be reduced below zero, the income in section 6.2 also cannot be reduced.
Well, they're saying that, but I think they're focusing on those, and they quote those words. So what they're looking at section 6 is they're saying, well, yes, there's a deduction to be made from a person's total income by 539. The amount of the deduction is based on the deficiency as you referred it, but at the end of the day, the overall limitation is in the final words of section 6, as if his income were reduced by that amount. That's what they see. I'm not saying they're right or wrong, but that's what they seem to be
Yeah, well,
concentrating on.
my lord, yeah, I think your lordship is right that's what they're focusing on.
That's what they're focusing on, that language, which imposes a limitation, because it's talking about a reduction of the income.
Yes, but we say the key words are the words that amount, which is a reference to the amount of the deficiency in 5391. That's what has to be used to reduce the.
That's the amount by which you reduce it. So I'm just trying to focus on the. So basically, this is the tension between your case and the upper tribunal reasoning. Is you say the critical words are by that amount, and they say the critical words are the words his income for the year were reduced.
Yes.
That's the tension, is it?
Yes. Yeah. And yeah, I mean, well, we come back to the amount of the deficiency. If you reduce, we would say that if you reduce your income under 4.4 by less than the amount of the deficiency, in other words, you only use part of it, you have not reduced it by the amount of the deficiency, which is what the statute, in our submission, tells you to do. So, paragraph 35, the tribunal go on really to, in the opening part of that paragraph, to reiterate that point, and then they quote some passages from the upper tribunal, which they then proceed to agree with.
Really, that's it. I mean, there's not much more one can say, really.
Well,
Is there?
there are some other reasons which are advanced by the tribunal, which I need to deal with. I need to talk about our argument based on purpose. I want to show briefly the 2007-8 wording of the legislation, which disposes of the argument that we have just been discussing. So there are one or two other points to cover, but your lordship is right at the end of the day. That's the core of the argument. I can perhaps move on. Just looking at the passages quoted from the upper tribunal.
I think you mean the FTT.
Sorry, the FTT. Sorry, I beg your lordship's pardon. The passages from the FTT. See, paragraph 94 is talking about.
So should we look at the FTT now?
My lord, no. If your lordship looks on page 71 of the
I see.
the paragraphs quoted with approval from the FTT. I don't believe we need to go back to the FTT to look at them. But the upper tribunal endorsed this reasoning. And in paragraph 94, they say that the effect of our approach is to extend the basic rate limit by the amount of CDR, which is it is another way of looking at it, although it's not the way that the statute quite puts it. But in 94, it said, if that approach is extended to the provisions governing rates of CGT, the effect is to give relief for an income tax relief to reduce tax on capital gains. Well, we would say that is absolutely the whole object of the exercise. There's no doubt that you can use CDR, even on the revenues construction, to reduce your tax on capital gains. But the tribunal says that would be a major step. I cannot discern such a broad purpose from the scheme of the Act. The legislation does not provide for a perfect integration of income tax and CGT. If it were to be so, the legislation would allow for release from income tax to reduce capital gains and vice versa. It does not do that. Well, we accept, and this comes back to my point about reliefs against the amount of total income. They are not available. You can't simply take every income tax relief and transfer it across to your capital gains. That would be a major step. Economically, there may be something to be said for complete integration, but it's never been attempted. The purpose of the legislation we are looking at is not to attempt a complete integration, clearly not to do that. It is simply to unify the rates of tax, which is why it's reliefs like it's why CDR is as a relief which alters the rate, which is picked out as an income tax relief, which you can transfer across. And 95 is another, with respect, failure perhaps to appreciate the nature of our case. Mr. Firth, who appeared by himself before the FTT, said, as I say today, that our interpretation is the only interpretation that gives full effect to the purpose of the legislation, namely to tax capital gains at the same marginal rate. It's the only interpretation on which the next pound of income or pound of gain will be taxed in the same way. And as far as CDR is concerned, that is, we say, undoubtedly right. But what is said against that by the FTT is that it's not the case that for all the income and gains which might otherwise be absorbed by unused losses or reliefs taken into account in computing total income, which is a subject received. So it's said as a criticism of our approach to CDR, to say, oh, well, there are lots of other reliefs which aren't taken into account. But the point is that CDR is a relief that Parliament did want taken into account, specifically provided for that. And so where you're dealing with a relief which Parliament specifically said should be available to reduce the amount of tax on your chargeable gains, then if you're attempting to find a unified system of rate of tax, then you would expect it to be unified. The fact that there are, of course we accept, but something, as you said, like loss relief, is not, if you've got more loss relief on your income than you can use in a particular year, this legislation doesn't allow you to carry that across. That would be a complete unification of the two taxes. But CDR goes to the rate, and that's why CDR, in my estimation, has been picked out as a relief which should be capable of being carried across. So 96, the FTT says that 6.2 is more limited. It's to turn an income tax relief into a relief which can be used. It is not to turn an income tax relief into a relief that can be used to reduce CGT. The aims of Section 6.2 are to identify the calculation of total income that is relevant and to ensure the effect of Section 4 does not deprive the taxpayer of the benefit of the basic rate threshold in a case where CDR is claimed. Without 6.2, if the amount of CDR exceeds the amount of income which is subject to tax at a higher rate, capital gains tax will potentially be taxed at higher rates, even if there would have been additional capacity within the basic rate threshold. Well, that's the effect of the approach to construction which HMRC advocated and which the tribunal accepted. It does simply protect the availability of the basic rate band. But that is not, we say, likely to be the result that was intended. Certainly if you're looking to unify the rates. And it's not, for the reason we've given, actually, what the wording of the section requires.
I mean, no doubt it will be said against you that it is right to read it in that more limited way, because that really is what Section 4, subsection 4, is all about. I mean, it is there in the first place as a way of protecting the basic rate band. I mean, I just have a limited read across in relation to CDR to ensure that, yes, that will still be taken into account, even though if you look at Section 539 in isolation, it's just something to do with higher rate tax only, and therefore would drop out of the picture altogether if there weren't this special provision made to bring it back in.
Well, look, yeah, but that's the other side of the coin.
Well, exactly. I mean, the question is, which is the right interpretation? Yeah. But it may be said that it helps one, or perhaps is a pointer towards the more limited interpretation clarification. Section 4, subsection 4 itself is really just to do with preserving the basic rate band.
Well, the first three subsections proceed on the assumption that you're looking at a case where there are no other, there is no CDR or other deductions to be made. But then the question arises as to what is the effect of subsection 4 when it talks about reducing income by an amount. Sorry, the effect of subsection 6 when it talks about reducing your income by an amount.
Well, it does, but all of that is for the purpose of telling you how section 4, subsection 4 is to have effect in relation to CDR.
Well, but the other issue, my lord, and this is actually the next point that the tribunal come on to in paragraph 36, is what is the basic rate band?
Yes.
Because the tribunal, accepting HMRC's submissions, said, well, there is some natural meaning to the basic rate band. It's on our hypothesis, the band of income between 0 and 40, and 40,000, and therefore that what is being protected here is just that slice of income. Now, we say, well, neither basic rate band nor unreduced basic rate band are terms which have an ordinary meaning outside the statutory context. And when we accept that, generally speaking, it's often the case that the basic rate band is used to refer to the position between the band between 0 and 40,000 of income. But it's not actually the way that basic rate tax works. If you take up our skeleton, where we deal with this point, this is behind tab 2. It's around paragraph 50. In paragraph 49, we just make the point that basic rate band hasn't an ordinary meaning in the sense referred to in some of the authorities. It is often used, we accept, to refer to 0 to £40,000, but it's not like, and this is one of the cases referred to by HMRC, like a village green, which has some kind of identifiable existence outside the construct of the legislation. Basic rate band has to be interpreted in the context in which you find it, and for that purpose we quoted in paragraph 50 section 1 of ICTA, which provides that where any act enacts that income tax will be charged for any year, income tax will be charged for that year in respect of any income which is not fall within paragraph AA, which I think was the starting rate, which we just omitted, or paragraph B below, at such rate of way determined to be the basic rate for the year. And then 3, the amount up to which an individual's income is by virtue of subsection 2 chargeable for any year at the basic rate shall be known as the basic rate limit. So the basic rate limit is the amount up to which you pay basic rate. So if you have CDR available, say £30,000 on top of your 40,000 assumed basic rate, then your basic rate limit will go up to £75,000. It is not defined as £40,000 or any particular figure. It is the rate. The basic rate limit is the amount up to which an individual's income is chargeable for a year at the basic rate. So we would say that the basic rate band, if you're looking for a meaning for it, flexes, as it were, with the amount of relief you have available. So there is nothing remarkable when one is looking at the concept of the unreduced basic rate band, which is only defined in section 4.4. Sorry, unused part, I do, not unreduced, unused. If you're talking about the unused part of a basic rate band, you're looking at the amount of your income which is taxable at the basic rate, and you find out how much of that has been used. And the rest of it is the unused part.
Yes, it talks about, just trying to see this. Yes, the language of the Act is in terms of the basic rate band. I see. It's slightly odd this because section 1.3 talks about the basic rate limit.
Yes.
So that's talking about the bit, which I think is what you're talking. I think you're referring to the basic rate limit, aren't you?
Yes.
But the language that's used in section, and this is just a completely neutral point, but the language that's used in section 4, subsection 4 of the TCGA is basic
Rate band.
the basic rate band. Basic rate band. So basic rate band is not.
Is
You
not
can
defined.
say the basic rate limit is defined.
Yes.
But you can't really say the basic rate band is defined.
It is not defined, but
You say
if-
the same thing.
HMRC said, well, the basic rate band is the band between if you normally pay tax at your income above £40,000, which is our hypothesis, then HMRC said, well, the basic rate band is 0 to 40,000, and that's all it is. But we say that the basic rate band is anything up to the basic rate limit. And the basic rate limit is defined by the point at which you no longer pay basic rate tax. So the basic rate band does not have to be, on our hypothesis, £40,000.
So that's maybe quite an important part of your argument.
Yes.
So can you just 1 minute? Just want to go back. Yes.
Now, what I'd like to do next is just show you very briefly the key difference between the 067 and 078 legislation. both parties say they mean the same, but they say they mean the same in different ways. But if we just skip ahead in the decision to paragraph 49, this is the 0708 version of section 6, and it refers in A again to 539, where a person is entitled to relief by reference to the amount of a deficiency. It says section 4.4 shall have effect as if the person's step 3 income, which is has been substituted for total income less deductions, because under the Income Tax Act 2007, step 3 income is the equivalent concept. So it says under amended 6.2 that section 4.4 shall have effect as if the person's step 3 income for the year were reduced by the amount of the deficiency. Now we say that's it's pretty clear that was the amount of the reduction under the previous legislation, but certainly under 0708 legislation it is absolutely explicit that the reduction has to be by reference to the amount of the deficiency. And then 539, which deals with relief for deficiencies, is differently structured completely. It from an income tax purpose point of view, it comes to the same thing. But it talks simply about a tax reduction and how to compute it, rather than talking about a deduction from total income for the purposes of extra liability. So although it's rather longer, it's now organised in a way that makes a bit more sense in terms of showing what the section is actually aimed at doing. So that's all I think you really need to see on the 2007-2008 legislation. Before I move on to my argument based on the purpose of the legislation, there's just one other aspect of the legislation which the court probably should see, partly because there's a point to be gained from it, partly because if the court is interested in the background to how these how this corresponding deficiency relief claim came to arise, you just need to understand this. And that is, if we go to section 6, as it appears in the authorities bundle, because this subsection is not quoted in the decision.
Which page?
So we're looking at tab 3, and it's the second page into the tab. So it's the 0708 version of section 6. So we've looked at 2, which is concerned with CDR 2A. And then subsection 3 says, where by virtue of section 465 of ITOIA gains from contract of life insurance, a person's total income for a year of assessment is deemed to include any amount or amounts Section 4.4 shall have effect as if his total income included not the whole of the amount or amounts concerned, but only the annual equivalent within the meaning of Section 5361 of the Act, or as the case may be, the total annual equivalent within 537. Now, this is a reference to a slightly arcane topic called top slicing relief, which operates when you make a gain on a life contract, as subsection 3 indicates. That gain is deemed to be your income. But because you're making a gain in respect of a policy you may have held for several years, the legislation recognises it would be unjust to tax you at higher rate in the ordinary way on that gain, representing as it does maybe 4 or 5 or more years of holding the policy. So the way top slicing relief works is that you divide the gain by the number of years you've owned the policy. And that is the annualized, the annual equivalent, which is referred to in 3A. And then you compute the tax payable on the assumption that you just made the annual equivalent profit in the year of assessment in question, and then you multiply that by the number of years you've held the policy. So it's a way, if you had no other income, and you had a policy you'd owned for 4 years and you've made an £80,000 gain, the legislation recognises that granted that £80,000 represents 4 years worth of ownership, it would not be right to tax you on the basis that you had made a gain of £80,000 and to charge higher rate tax on the gain. So what it does is it says divide that 80,000 gain by 4, which is the number of years you've owned the policy. Compute how much tax you'd have paid if you'd only had £20,000 in the year of assessment, and that would be basic rate tax. And then you pay 4 times that amount. So in other words, it enables you to spread for basic rate tax purposes again over a number of years. Now what's interesting about 3A is that it does say that the I'm reminded that having said you pay basic rate tax, because the insurance companies paid the basic rate tax, you then get a tax credit essentially to wipe out the basic rate. So you wouldn't actually in the end pay anything in my example. So it's the difference. What's at stake is the difference between basic rate and higher rate. But what section 3A says is that when you're computing total income for the purposes of section 4, you don't include the whole amount of the gain, but only the annualized amount. So that's an example of a situation where total income for capital gains purposes is different to total income for income tax purposes, because total income for income tax purposes is the whole gain. Top slicing relief simply affects the rate of tax you pay.
But I mean, does that really help us? Because that's a case where you're deeming the taxable income, as it were, to be of the finance to be less.
Yeah.
Whereas this case, in our case, you want to deem the income to be more in a way, for the purpose of calculating the rate of tax.
Well, my lord, no. What happens in that situation, and I mention this because it's the way of making sense of the figures that my learned friend puts at the beginning of his skeleton about how much income and how we made and how many gains we made. Because this top slicing relief applied actually in the instant case in 2006-2007. You can see from the tax calculations right at the back of the trial bundle, I don't really look at it now, that in fact in 2006-07 Mr. Scott's CDR was less than his total income. But so for income tax purposes, he was not seeking a claim of relief which was bigger than his income. the reason why his CDR exceeds the amount of total income in the capital gains tax context is because of this provision, which reduces total income for capital gains tax purposes down to a level where his CDR exceeds the amount of his total income.
Well, at the moment, I mean, you add that extra bit on, but I don't see at the moment how Section 6.3 really helps us insofar as it's simply the basis for your proposition that here's an example where total income for tax purposes is different from what is taxable for CGT purposes. I don't really see that.
But
maybe so.
It gives rise to the possibility, which actually happened in the present case, but you could hypothesize numerous examples, in which the amount of CDR which is being claimed, as it were, below the line, the negative amount of CDR, was actually less than total income for income tax purposes. So criticisms that this is that you're reducing income tax total income below zero are misplaced. All you're doing is reducing this artificial construct for capital gains tax purposes of total income below zero.
Mr. Furness, I may have got myself in the muddle. I'm still not quite clear which year's version of Section 6, subsection 3 we're looking at, and does it make any difference, or does it matter?
It doesn't, no, for this point, my Lord, it doesn't make any difference.
I think you've been referring us to the 0607 version.
Yes, I'm referring to the section behind tab 3, which is 0607.
Well, in fact, your starting point was the key differences in 0708.
I'm sorry, my Lord. I've moved on. I do beg your pardon. I'm responsible for the muddle. I've moved on from that. This is a distinct point.
Yes, thank you.
Well, at the moment, I mean, it's important I understand what you're saying. At the moment, I can't, I may be alone here, I can't see at the moment how 6.3 in any way delivers any decisive blow to the revenues approach to this. I'm not following that. I mean, I understand what it says. It says that you, for the reasons you've mentioned, the top slicing point, that you're not including the whole of the amount, but only, in the case you gave of the 4 years, 20%.
25% for 4 years.
25%. I mean, I understand that, but at the moment I can't.
Well, it simply illustrates the possibility, which actually happened in this case, that you could have CDR, which takes your total income for Section 4 purposes below zero, but which does not take your total income for income tax purposes below zero. So this argument that somehow you can't make deductions which take your...
Do you mean by this that the legislation itself has limited that possibility?
No, what I mean, my Lord, is that coming back to the line of argument one sees in the upper tribunal, that because for income tax purposes you cannot reduce total income below zero, which we all accept, therefore you cannot take corresponding deficiency relief, which puts you into negative territory. But in 2006-07, the reason why our corresponding deficiency relief goes into negative territory is not because it's less than our total income for income tax purposes. If you're worried about that rule, we didn't breach it. It's simply because it's less than total income as defined for the purposes of capital gains tax in this legislation. So it's simply, I would submit, another nail in the coffin of the idea that because total income for income tax purposes cannot go below zero, therefore you have to import the same reasoning across into Section 4.
I understand. Okay, I understand. I understand the point.
Sorry? I think they've got it.
Maybe we make a note of that.
Now,
Which was the year in question we're talking about?
we were talking about 067.
So the reason why in 0607 you say CDR exceeded taxable income was because of this provision.
Yeah.
That all of that goes to show.
Well, it exceeded the income as defined, total income less deductions as defined in.
I meant that was a shorthand. But I mean, surely all that goes to show is that whatever is your taxable income or your total income, less appropriate allowances, it depends upon the tax scheme. That's all you're saying is, well, what is a, I think what it comes down to is what is your taxable income for income tax purposes will depend upon a whole series of different provisions which apply to different people in different ways. It's not some sort of abstract construct that applies to everybody. That's all you're saying, really.
Well, what your lordship has just said is with respect quite true. But no, what I'm saying is that the line of argument which says that because total income for income tax purposes cannot reduce below zero, means you cannot deduct a CDR which is bigger than your total income for income tax purposes, falls away when you realise, as happened in 2006-07, that our CDI was less than our total income for income tax purposes, but was lower than the special definition of total income which is used in this legislation. There is simply a disconnect between the two. And it also shows how careful the draftsman is being here to ensure that, obviously, gains and losses on life policies very much at the forefront of Parliament's mind here, because they're dealing not only with CDR, which they deal with in Section 2A, but also with top slicing relief, which they deal with in Section 3. The draftsman is making a real effort to ensure that the reliefs which you get for CDR and the benefit of top slicing, which can again affect the rate of tax that you pay on your event gain, if you dispose of a policy for a gain, are then written into the unified system of rates in the capital gains tax legislation. Now, I just want to come back and say something about what was our first ground of appeal, which is the purposive construction point, which is dealt with by the tribunal in paragraph 42 of the decision. Paragraph 42 in the following.
Yes.
In paragraph 42, they refer to my submission, which I repeated today, that the whole lot of the exercise was to allow income tax relief to be used to reduce tax on chargeable gains, and they agree, but don't think that's an answer to the point made by the FTT that what the legislation does not do is integrate taxation of income and chargeable gains, or provide generally that income tax reliefs are available against CGT. And then in 44, they say in relation to, again it's talking about those paragraphs that were quoted by the upper tribunal earlier. Mr. Fone said the rather limited purpose of the legislation identified by the FTT did not fulfil the statutory purpose of unifying tax rates on income and chargeable gains. We agree that the general purpose of Section 4 was to unify the rates of income tax and CGT, as can be seen in the way that it works in the ordinary case, and was reflected in the heading, Section 98 to 103 of the Finance Act, when those provisions were first enacted, and I showed your lordships that at the outset. But he says, we do not think this general aim can control the interpretation of Section 6.2 of the Act, that is to be found primarily by construing the words, not by appeals to the general policy underlying the provisions. Well, we say that's to take a far too narrow approach to applying the purpose of the legislation. We say that there are two perfectly good interpretations of the legislation. We say linguistically ours is better. HMRC, of course, say that linguistically theirs is better. Indeed, I think they go as far as to say that ours doesn't exist. But on any view, we have good arguments at its lowest in favour of our construction. And if our construction better serves the evident purpose of the legislation than HMRC's construction, then it should be adopted. And to say, oh, well, we must concentrate simply on the wording of the legislation and we can't get away from that. I mean, that's only true if there is no other construction available. And so you are reluctantly forced to adopt construction which goes against the evident purpose of the Act. But where there's more than one construction available, then clearly one should be looking to adopt the construction which best serves the purpose. And we have quite a relatively recent authority in the bundle from the Supreme Court adopting a purposive approach to the construction of taxing provisions, which is behind tab 20. It's the UBS AG against HMRC case. Which concerned some complex transactions entered into by banks with a view to delivering executive bonuses tax-free. And they engaged in some admittedly artificial transactions to take advantage of the provisions of Chapter 2 of Part 7 of ITPA, Income Tax Earnings and Pensions Act 2003. The problem facing the Supreme Court and the courts below was that although these were clearly tax avoidance devices, they appeared to be squarely within the terms of the legislation. And indeed the Court of Appeal, I'm not sure, was your Lordship sitting in that?
No, I was not there below.
No.
I was in the,
Yes,
I was in the Upper Tribunal.
yes, of course. The Court of Appeal, and I think also the Upper Tribunal, felt constrained by the wording because it was pretty. It was a sort of mechanistic type of legislation, sort of legislation one saw in the Mays case as well.
Very much on all fours as we saw it with the Mays.
Yes, that one just had to follow through the mechanism of the legislation. And there were some, I think, specific anti-avoidance provisions which didn't actually catch these provisions. If we look at paragraph 73, if the court just reads paragraph 73, you'll see the case for the banks essentially saying, well, you have no choice but to give effect to these transactions because they're within the literal wording of the Act. So they acknowledge that these are forceful arguments, which of course the Court of Appeal found persuasive. They then go on to say, but there are in context some indication of what Parliament intended, that it's concerned with particular taxation issues which arise when employees are remunerated in shares. So they make some fairly high-level general observations about the purpose of the legislation. And then in paragraph 77, they say, approaching the matter initially at a general level, the fact that Chapter 2 was introduced partly for the purpose of forestalling tax avoidance schemes self-evidently makes it difficult to attribute to Parliament an intention that it should apply to schemes which were carefully crafted to fall within its scope, purely for the purpose of tax avoidance. Furthermore, it's difficult to accept Parliament can have intended to encourage, by exemption from taxation, the award of shares to employees where the award of shares has no purpose whatever other than the obtaining of the exemption itself, a matter which is reflected in the fact that shares are in a company which was brought into existence merely for the purpose of a tax avoidance scheme. So they say the encouragement of such schemes, unlike the encouragement of employee ownership generally or share incentive schemes in particular, would have no rational purpose and would be positively contrary to rationality. So they then go on to consider the arguments around that. They come to their conclusion in paragraph 85. They say, in summary, therefore, the reference in section 4231 to any contract agreement, arrangement or condition which makes provision to which any of subsections 2 to 4 applies is to be construed as being limited to provision having business or commercial purpose and not to commercially relevant conditions whose only purpose is the obtaining of the exemption. So the court, with respect and fairly slender grounds, and on the basis of the observation that it could not have been intended that this code should be used for tax avoidance, has felt able to conclude that, notwithstanding the express words of the statute, that somehow it can be qualified so as to remove any ability to take advantage of provisions which have no business or commercial purpose and are only inserted for tax purposes. Lord Templeman, one can't help thinking, would have approved. But what one gets from this is, in my submission, it's a clear and recent and highest authority example of the court allowing and finding itself constrained by the purpose of the Act to, in this case, to read in an exclusion from the provisions which didn't actually exist. Now, we're not asking this court to do that. We say we have a construction. You don't need to read anything in. There is a construction there already which you can adopt. So we have a stronger case in that regard. And I would submit that the argument that the capital gains tax legislation is there to unify rates, and that by virtue of the inclusion of CDR within that regime to unify rates, having regard to the ability to claim CDR, that we have a much stronger and better founded purpose for the Act than actually existed in the UBS case, where in the end the purpose seems to be, well, it can't have been intended to avoid to be used for tax avoidance.
Can I just stand back from the whole thing, the detail for the moment, and look at it from this perspective that you've just given us, which is what is it likely that Parliament would have intended, to sort of stand back from the details. So the basic structure we get for capital gains tax is that if any part of your income tax exceeds your basic rate tax, the gains are charged at the higher rate.
Yes. So
that's the basic structure you start off with. But there may be circumstances where, and you've got a situation where, for income tax purposes, the government and the Parliament has decided that there should be a deduction for income tax purposes for CDR.
Yeah, it's a reduction in rate. Yeah.
Well, yeah, reduction in the rate. So what you're looking at is a situation where your income tax your income would exceed the basic rate band. So normally you will be subject on the whole of your gain to a higher rate.
Yeah.
But the government has said yes, but Parliament has said, yes, but that doesn't give full allowance for this CDR, which we think should not have to bear in certain circumstances the whole of the high rate.
Yeah.
Well, you can quite see, in a sense, standing back from the whole of the detail, that they might say, all right, well, there should be an allowance for this, as the Revenue suggested. There should be an allowance for this, standing back from the whole thing, so that you should be able to use this to reduce your basic, to reduce what would otherwise be the band, otherwise taken up by income, to calculate what the rate should be. And that means utilising the CDR to allow you to take advantage of what would otherwise have been the basic band of tax. But the effect of what you're suggesting is to give more than that.
Yeah.
Why would Parliament have wanted to do that? I'm just trying to stand back from the nitty-gritty, but just looking as they did in this case, they were, why would Parliament want to? Why would CDR be so special that it would want to give this additional benefit over and above an allowance for what would otherwise have been, for income tax purposes, your basic rate band?
Well, because if you're looking to unify the rates, then you're getting different. If you adopt the revenues approach, you're getting different results depending on how you mix income and gains. Whereas on our approach, it's seamless. It doesn't matter whether you have income or gains. Your CDR is available either way. It's about taxing income and capital at the same rate, which is what our construction achieves and what HMRC's construction does not.
All right. So that's what it comes down to at the end of the day. Is that it?
Is it? Sorry, can I just? I mean, it's a complex matter, and I've jumped around with my submissions. I just want to make sure there's nothing else. Yeah, it is just coming back, I think, to the point that I just made, that having a unified rate of tax means taxing income and gains at the same rate, so that if you have 100 of income and some CDR, you pay the same tax as if you had 100 of capital gains tax and some CDR. From that point of view, it looks arbitrary in our submission to say, well, you can go down to the basic rate, but no more. Because that isn't achieving that objective at all. I should perhaps just mention, so that the court understands it, because it's another subsidiary ground of appeal, really, that we say that there is no magic about, if you're looking at CDR, there's no magic about the zero level. Because CDR is only useful in an income tax context to reduce your income down to the basic rate limit. Below that, there's no point in having it. So although we said earlier, if it exceeds your income, you waste it. In fact, if it exceeds your income above the basic rate limit, you waste your CDR, because there's nothing else you can do with it. Now, before the First Tier Tribunal, the Revenue ran an argument that said that the amount that you deducted was simply limited to the amount of the deficiency you needed to bring your income down to the top of the basic rate limit, and that argument was lost and not pursued. But granted that, there is no, it seems to us, no particular magic in a zero floor. Once you've used your CDR to eliminate all of your income for higher rate tax purposes, then the rest of it, in our submission, not just the next 40,000 of it, should be available to relieve capital gains.
Yeah, I understand that, absolutely. That's very clear. Thank you very much.
I think I think I did give the court the explanation of the way that life policies are taxed, in the sense that the insurance company pays the basic rate tax, and I did at one point make an error in saying that if you claim corresponding deficiency relief, you still pay basic rate tax. But in fact, because the basic rate tax has already been paid and you are only ever liable for higher rate tax, CDR and top slicing, effectively both of them completely remove your liability for tax on income. where they apply. I don't think there's anything else. Thank you.
Very much indeed. Yes. And Mr. Pritchard.
My lords, my lady, I propose to structure my submissions in 3 sections. First, to make some introductory remarks, then to work through the legislation, making some submissions as I go through the legislation, and then finally to deal with the 6 of the appellant's grounds of appeal as were set out in the skeleton arguments.
Right. Yes, please do follow it as you see fit. But I think as Mr. Furness has developed his submissions, they come down to some quite narrow points.
Yes, and I hope to vacuum them up, so to speak, cover them as we're going through the legislation. And it may be that when it comes to dealing with the grounds of appeal, I'll just refer you to my skeleton, which I'll take as read.
Thank you.
Introductory remarks first. This is a case about statutory interpretation, and in this appeal we respectfully adopt the reasoning of the First Tier Tribunal and the Upper Tribunal. We say that the process of statutory interpretation must start with the words of the statute, and we say in fact that in this case it ends with those words of the statute. We say that the words are clear and unambiguous. We submit that the construction that my learned friend urges upon the court ignores the actual words that Parliament has chosen. In effect, he's turning the words that Parliament has chosen carefully into a series of algebraic items, and then performing rather elementary algebra on those algebraic items. And my learned friend took you to paragraph 30 of the Upper Tribunal decision, and that's where they quite fairly and accurately have reflected what are my learned friend's submissions. And the real art, he says, in his submissions,
I think to be fair to him, he says that's not how he presented it.
It's not how he presented it, but he accepted that it is the consequence. And the real art of his submissions comes on the 3rd line, UP equals BRL minus I minus D. Obviously, from a minus and minus, we get a plus. That is where he gets the outcome that he wants from the statute. We say, as I will expand, that the appellant approach is driven by a desire to turn the deficiency relief into a relief, rather than from a relief from income tax, higher rate income tax only, into a relief from capital gains tax and income tax. And we say that he tries to do that in the face of Parliament's legislation, which I'll show you, which expressly makes it clear that deficiency relief is an income tax relief. And of course, this court is well aware and accepted there are plenty of other reliefs out there that are unique to either income tax or capital gains tax. One high-level point to note at the outset of my submissions relates to my learned friend's example 3 in his skeleton argument, and if the court would be kind enough to turn that up, it comes on page 6 of his skeleton argument. And in this example, we see that the deficiency relief claimed is 35,000. The gains are said to be 100,000, but the income is said to be 0. Now there's a fundamental problem with this example, which shines a light on the whole of the problem with my learned friend's submissions. And one sees that if one turns to section 539 of the Act, taking the version in force in 2007-2008. It's behind Authority tab 6. Behind Authorities tab 6, if you could turn to section 539, please, my lord.
This section, I'm just trying to get the right year.
So This is for the 2007-2008 tax year.
So this is the second of the 2 years of assessment.
Yes, it is, my lord.
Right.
And one sees in section 539 relief for deficiencies. 1. An individual is entitled to a tax reduction for a tax year in which a deficiency arises from a policy or contract on a chargeable event if, sub B, the individual would, apart from this section, be liable to income tax at the higher rate, or the dividend upper rate, or both for the tax year. So one only has corresponding deficiency relief available to one if, but for the section on that relief, one has income tax, or one would be liable to income tax at the higher rate. Now, my learned friend's example 3, there is no income tax at all.
And you're referring us to that 539 because of the words in parentheses, aren't you?
The whole of section B, my lord. So one.
Yeah, but I'm seeing the extent to which it's different from what was set out in the the year before.
Yes. So one
The
B.
only difference is what's in parentheses apart from this section. Or would. And we can see on page 67 of the bundle of the core bundle from the upper tribunal decision, where they set out section 539. I was just wondering why you referred us to that one rather than the one that's set out that we've been referred to so far. There's very little difference.
It's very little. Sorry. Yes.
I wonder if you were making some point about the difference between
No.
the
It's
language.
just that was the one that I'd referred to in my notes, my lord. But yes, one has to.
You
have,
could equally well, because I need, for my purposes, it's helpful to be consistent with what people are looking at. So the position is, if we take the section 539, that page 67 of the bundle, you'd make the same point.
Yes.
Would have been liable to income tax. That's the critical point.
Yes.
That's under A there,
Yes.
and that's the equivalent to B in the version you've shown us.
Yes.
Right. Thank you.
But my learned friend's approach to the statutory construction doesn't take into account that limitation at all, and we submit that it's a limitation that arises because deficiency relief is a relief for the purposes of income tax. HMRC's approach, the one sees in my learned friend's skeleton argument at 19, does take that limitation into account, because one sees that the taxpayer is able to use the basic rate limit of £40,000 for the purposes of their capital gains. They're not able to use the alleged CDR because there is no relief, deficiency relief arising. Now, in my learned friend's submissions, he said on a number of occasions that
Well, I don't think it's not in dispute, is it? That CDR is it serves two purposes. One is as a deduction for the purposes of taxable income. And secondly, for the purposes of providing determining a tax rate for CGT purposes. It serves two purposes.
the first purpose is not an issue. The second purpose, that it determines a tax rate,
Well,
it is an issue.
it has an effect on
It has an effect, as all reliefs
I was
do.
using the neutral sense, and it has an effect on rates.
Indeed, but my learned friend is actually saying that it goes further and saying that it determines the tax rate.
Yes,
It
but
doesn't do that.
All I'm sort of trying to put to you I'm testing your argument, because Section 539 is concerned with the first of those. Section 6.2 is to do with rates, but Section 539 serves the income tax deduction purposes.
Yes.
So it's not surprising. I'm not sure what you. So I'm testing your proposition by saying yes. Well, it's not surprising. That's what Section 5391A, or in the second year, next year assessment, Section 5391B is saying, because that's dealing with a deduction for income tax purposes. That's what it's there for. What I think Mr. Furness would say is, well, yes, that may be so, but what we're looking at is the impact of Section 6.2.
Yes, but if one looks at 6.2, so, my Lord, I think you're looking at the upper tribunal judgment
Well, I think this is helpful because we've been referred to that.
at 25.
Yes.
That says where for any year of assessment, by virtue of 539, a deduction of an amount is made.
Yes.
And my learned friend focused on the words an amount,
Yes.
but failed to, or didn't draw, we would say, sufficient emphasis to the words is made from a person's total income.
Yes.
So the amount that is being referred to in 2 sub A is the amount of deduction that is actually made under 539. And one sees at the bottom of 6.2, the rider, section 4.4 shall have effect as if his income for the year were reduced by that amount. The reference to that amount there is a reference to the amount that is made from a person's total income. And that is the argument that the upper tribunal were explaining in their judgment, where my learned friend said to you, well, we see an amount as being a reference to the deficiency relief that would potentially be available. But that doesn't answer the argument, because 6.2 is talking about the deduction of amount being made from a person's total income. My learned friend on a number of occasions said that HMRC accept that CDR can be used to some extent as a relief from capital gains. We do not accept that CDR can be used as a relief from capital gains at all. What our interpretation permits is that CDR can be used to its full effect for income tax purposes. And if one has any basic rate limit left after using CDR to its full effect, one can use that remaining basic rate limit for the purposes of capital gains. But that is not the same as saying that the CDR is being used for capital gains purposes. It's the basic rate limit that's being used for capital gains purposes. Still under the heading of overview point, 2 further points I'd like to make, my Lord. First is the submission that the legislation this court should be looking at is the legislation from the relevant tax years. But I take from indications from the bench previously that the court is ad idem with the commissioners on that point. To the extent that authority were required, it's a point that was made by Lord Bingham in Spathholm at 388C. And that is that the starting point for interpretation is the legislation at the relevant time, whilst it can be appropriate in some circumstances to resort to historical versions of the Act. That is only when there's ambiguity, and we don't see it is here. It's the approach the upper tribunal, paragraph 8 of their judgment.
Just give us the reference in the bundles to that case.
It's authorities tab 12.
Thank you. And it's page 8.
Page 388C.
Yes, thank you.
It's the upper tribunal judgment, paragraph 8, is where they, I think without referring to Spathholm, but they, in summary, take the same approach.
I mean, you do get, I seem to remember, you get this peculiar thing, particularly in tax statutes, where legislation is in pari materia, and you can look at the broad sort of stretch of it. to see sometimes. I mean, you say that only arises where the language is unclear.
Yes. The second point is that in terms of deriving the purpose of a statute, the starting point will always be the words that are used in the statute. And it's from those words that one discovers Parliament's intention. Lord Nichols in Spathholm, Authorities Bundle 12, he makes that point at page 396E. Once the purpose has been identified, of course it is then the task of the tribunal or the court to construe the statute to give effect to that purpose, and we accept my learned friend's submissions to that extent. There obviously is a caveat to that, and even purposive interpretation has its limits. An example in the bundle, there's no need to take you to it, is the Shahid and Scottish Ministers case, Authorities 19. At paragraph 20, Lord Reid said, no amount of purposive interpretation can, however, entitle the court to disregard the plain and unambiguous terms of the legislation. And we do submit, we are heavily in the category of clear, plain and unambiguous.
Yes, and another, perhaps the flip side of that is equally one has to be very careful of stating a purpose, which is really just a question begging assumption, and then construing the legislation in a way that gives effect to the purpose you would rather like the legislation to have, rather than one which one has genuinely derived from its wording properly construed.
Indeed, and we do submit, and this is a point that I'll come to, that the Upper Tribunal drew our attention to, the statute as we see, and my learned friend referred to the subtitle of the 1988 Act, refers to unifying rates. And as the bench has referred to, what one sees in section 4 is one saying the capital gains tax has the same rate as income tax. My learned friend then takes that one stage further and says that it's not just the rate, the figure that is being unified. It is in some way the reliefs that one can claim arising from one's liability. And in some way section 4 is saying anything about that. Now we submit it's not, and we submit one sees from the plain words of section 4 that is all about unifying the rates of the two taxes. If I may now turn to the legislation itself, and the court are looking at paragraph 25 of the
Standing back from it all, I suppose again I'm trying to test your point. I mean, what and I may have got this wrong, but what Parliament has not done is it has not, as I understand it, it's that for income tax purposes, is it right that the whole of CDR is either taxed at the nil, it's taxed at the basic rate?
There's no. Yes, that's the end. That's the conclusion. But the mechanism it does that, and I have taken this for the first time today. My learned friend suggested that the basic rate limit is increased by the amount of CDR. That's not right. What the legislation does is provide that you don't have to pay higher rate tax, excess liability on the CDR.
So I suppose, although I don't, well, Mr. Phillips is putting it this way, but my language is rather cruder, if I can do it this way. Well, why it may be said against you, what is so odd about Parliament saying, well, for income tax purposes, we're going to treat all of this, however great it may be, the CDR, it's going to be taxed at certainly no more than the basic rate. If that's true for income tax, why shouldn't that be true for capital gains tax? What's so odd about that?
If Parliament had intended to do that, it would have made CDR into a capital gains relief. And one sees in other areas of tax, so gift aid is an example, where one does increase the basic rate limit, so it has the effect that my learned friend is asking for, and that's the mechanism that Parliament has used. But Parliament has decided that in this case, CDR is not to be a relief for capital gains purposes, and that is, we submit, a perfectly rational position for Parliament to have taken. Parliament could have decided otherwise, and it would have made legislation that made that clear, that now it becomes a capital gains relief. But it hasn't done that. What it's done is, we submit, it is enacted legislation that protects the basic rate band and allows an individual to use their basic rate band for capital gains purposes.
So, I mean, again, standing back, suppose we have a case, as I imagine is obviously is the position here, where the taxpayer in question has very large capital gains of several £1 million. In the normal way, they would obviously be taxable at the higher rate because they're miles in excess of any basic rate band. And yet what is being said is that somehow as it were, as a side effect or a knock-on effect of the CDR for income tax purposes, that all those gains, which are entirely extraneous, have nothing whatever to do with the life policies which are being invested in, they are to benefit from a rate of tax which is half that which would otherwise be applicable.
Indeed, my lord. And
I mean, that is a startling result.
it's a startling result, and it's a result that comes in very rather unique circumstances. And you may not, or you may have seen or not seen in the FT tribunal, there were judicial review type arguments run. Similarly, there was a judicial review in this case attempted in the administrative court based on legitimate expectation. And the reasoning of the court, of the FTT and the admin court, explained that the appellant finds himself in rather unique financial circumstances. I forget the exact figure, but he's one of a very few number of individuals who has such a high CDR potential.
I think it was in the 20s, wasn't it?
It was, and I think if I recall correctly, most others were around £25,000, but the appellant was £20 million. So we would submit it's not surprising that Parliament didn't consider it necessary to legislate for the appellant's financial situation, because it's such a unique financial situation. My Lord, I hope that answers the question you posed to me.
Yes, thank you.
I was taking the court to the legislation, and the court have been using paragraph 25 of the upper tribunal.
Yes, thank you. So you've got the basic essence of what your case is at the moment. You're saying a CDR is effectively a relief for income tax purposes in terms of deduction. So far as CGT is concerned, it all turns on section 6. You emphasise the words "is made." It's the amount that is made, and that is made for income tax purposes. We've got that.
Yes. Well, in which case, can I accelerate my submissions through to discuss the unused part of the basic rates band? And one sees that at in section 4, subsection 2. Sorry, subsection 3.
No, that's I think it's section 4.4.
4.4, yes. So it first appears in 4.3, which says that if no income tax is chargeable at the higher rate in respect of the income of an individual for a year of assessment, but the amount on which it is chargeable to capital gains tax exceeds the unused part of his basic rate band, the rate of capital gains tax on the excess shall be equivalent to the higher rate of income tax for the year.
Yes.
And we submit that the purpose of this subsection is that Parliament has said there is a level above which capital gains are payable at the higher rate, and that level is determined by the unused part of the basic rate band, and the Parliament has chosen the words unused part so that Parliament is identifying a part of a whole. And the whole is being described as the basic rate band. So that gives rise to the question, what is the basic rate band? Now we submit that one sees an indication of what basic rate band should be taken as to mean in subsection 4. Subsection 4 defines the unused part of the individual's basic rate band as a reference to the amount by which the base rate limit exceeds his total income as reduced by various deductions, and it's accepted and agreed by all parties that those reductions don't apply here. The term is used, the basic rate limit. Now, in all the examples that have been put before the court by the parties, the basic rate limit was said to be £40,000. Now, in submissions for the first time today, my learned friend said that, in fact, the basic rate limit extends to include your CDR. And I do say that's the first time today because one doesn't see that argument at all in the upper tribunal. And if one looks at my learned friend's skeleton arguments,
It's extended by the CDR.
it's by the CDR. If one looks at my learned friend's skeleton arguments, paragraph 50,
Yes, that's what he shows.
there's a quote from section 1 of the ICTA, and my clerks have helpfully, whilst I've been on my feet, run across copies of the full section so I can hand up in due course. Then paragraph 51, my learned friend says, thus a person with no CDR and income of 20,000 still has a basic rate of 40,000 because that is the amount of income which he could have paid basic rate. Similarly, a person with CDR would, if he had sufficient income, pay basic rate tax on an amount of income equal to 40 plus CDR. His basic rate band is equal to 40 plus the CDR. So my learned friend there is saying that the basic rate band is equal to 40 plus CDR. But he didn't say that the basic rate limit is increased by CDR. Now he has made that argument. That argument is a bad argument. The basic rate limit...
So he's saying the basic rate limit is extended.
Yes. But that is a misreading of the legislation because the basic rate limit does not include the deficiency relief. And the reason that is because the way deficiency relief works, as we've seen, is you calculate your basic rate tax, you then work out what your excess liability is. And your excess liability is calculated by, amongst other things, taking into account whether or not you have any CDR. So you've already done the stage of working out what your basic rate, basic tax liability is by the time one gets to consider CDR. CDR is a relief from extra liability, which for shorthand in this court we've been referring to a higher rate of income tax.
So just in your language now, by the time you get to CDR, you've already worked out, how did you put it? You've already worked out
Your liability for basic rate tax.
for CGT purposes. For what purposes?
For income tax purposes.
For income tax.
And then one uses CDR for the purposes of determining your extra liability. And the court may recall that that is in subsection 3 of section 539. So in the upper tribunal decision, that's paragraph 26.
I'm trying to understand this point. So we're now looking at, because you're now crossing over between section 4, capital gains tax and income tax. I want to understand how this is panning out.
Yes.
When you say by the time you get to CDR, you've already worked out your liability for basic rate tax. You're there looking at your income tax calculation.
You are.
So we're now looking at the point at which you get to 539.
Yes.
So what you're saying is you're going to work out what your rates of tax are. Is this right?
Yes.
And you put CDR to one side at this point. Is that right?
Yes.
And then you look at 539
Yes.
and you apply 539. That's how you say it works.
Yes. And in 539 subsection 3, we see that it says that subsection 1 only applies for the purposes of determining the individual's extra liability.
So, does it have to be done that way? Why does it have to be? Why does it have to be done that way? I mean, why under 5391? Why can't you do it all before you in working out the total income? I don't understand why you say it's done in stages, in the way you have done for income tax purposes.
Yes. Because deficiency relief is a relief only from extra liability. And although we talk about higher rates, it's not really a concept in the tax legislation. We're talking here about extra liability.
I mean, it's a slightly odd way of drafting, but if one reads the section as a whole, which of course one has to do, I suppose you say the effect of subsection 3 is really sort of limit the apparently otherwise unlimited scope of subsection 1. I mean, it is only for this one limited purpose that this deduction is being allowed.
Yes.
It might, so it might have been helpful to say that right up at the beginning rather than halfway through the sections. But I mean, that's how the draftsman has chosen to do it.
Yes.
Right, and then so that's how it's done for income tax purposes, and then but you're referring us to section 4.3 and 4.4 of the TCGA. So you're then right, let's assume you're right for the present purposes in the way you said the income tax is dealt with. And what do you get out of this? So you were saying that's how you constructed it for income tax, and then you say you now look at these CGT provisions.
Yes, and we in subsection 4, the unused part is defined as the basic rate limit, how much the basic rate limit exceeds total income. And my learned friend seemed to be saying today that the basic rate limit is somehow flexible, and for the purposes of CDR, one could take 40k plus, to use the appellant's financial position, plus 20 million, to give a basic rate limit of £20,040,000. But that's not right. The basic rate limit is always 40,000. And indeed that is how the upper tribunal have characterised my learned friend's argument about paragraph 30, which he said, albeit it's not how he made his submissions, but was a fair characterisation. That third line of the equation, unused part equals the basic rate limit minus, in brackets, income minus deficiency relief. And that's why one then gets to £40,000 plus your deficiency relief. So that's the way this case has been put up until now. But as I say, in his oral submissions, my learned friend was now saying that in fact the basic rate limit increases by the amount of the CDR. But that's not correct. To see an example where the draftsman has decided to be flexible with the level of the basic rate limit, if the court could turn to paragraph 38 of my of my skeleton argument. There's a reference here to the gift aid provisions. As I say at 38, in the middle of the page, 4 lines down, CDR does not increase the basic rate limit. If Parliament had intended it to do so, it would have said as much. Compare for the provisions in relation to gift aid, and they say the Income Tax Acts have effect in their application to the individual for the tax year in which the gift is made, as if the basic rate limit were increased by an amount equal to the grossed up amount of the gift. So gift aid is an example, and I think there's one other, pensions relief, where one expands the basic rate limit. CDR is not an example where the basic rate limit is expanded.
Have you got the reference to the pensions relief?
Over the break, I will get the reference, my lord.
Just before I forget, I mean, it's very useful to use £40,000 as a kind of notional figure, but could somebody tell us what the actual figures were for the 2 years we're concerned with?
We will do, my lord.
Thank you very much.
Is that a convenient moment to stop?
It is, my lord.
How are you doing in terms of time?
I will re-evaluate. Certainly my submissions were drafted longer, but I think we are getting to the nub of the arguments.
Thank you very much.
Cool, guys.